Silver just dropped about 17% in one day. That kind of fall feels like a punch in the stomach. It makes people shout and search for someone to blame. And the fastest blame is always the same. People say manipulation, like that one word explains everything. It feels comforting because it gives your anger a target. But here's the scary truth. Silver can do this even without a secret meeting in a dark room. If you want to survive silver, you must understand how the market is built. Today we are stepping away from the noise. We are not doing viral math or rage posts. We are doing structure because structure beats rumors. Because silver is not broken. Silver is not cursed. Silver is designed to swing hard. A lot of people think prices move like a clean bell curve. That means big moves are almost never supposed to happen. So when silver drops fast, people say it must be impossible. But silver does not follow that clean pattern. Silver has fat tails, which is a fancy way to say extreme moves show up more often. What looks crazy is actually part of silver's normal behavior. Think of it like weather. Some weeks are calm, with light wind and small changes. Then a storm hits and everything gets loud. Silver also switches between two modes. It can stay calm for long stretches. Then it can snap into storm mode, where big swings happen again and again. So the question is not, how could this happen? The better question is silver in storm mode right now? When silver is in storm mode, a huge move is not a miracle. That is why silver shocks people. They expect a quiet market, but silver is not quiet. It is a market that can flip fast. Now let's talk about the biggest reason silver swings so hard. It is not one evil trick. It is the simple size of the part of silver that can actually trade. People say, there's plenty of silver above ground. That sounds true and it sounds safe, but most of that silver cannot move when price changes. A lot of silver is locked inside electronics. A lot of silver is stuck in solar panels and machines. A lot of silver is sitting as jewelry that people do not sell quickly. So what really matters is the investable float. That means the bullion that investors can buy and sell right now. And that pile is much smaller than most people imagine. This is why silver can act like a tiny boat in big waves. When money flows in, it pushes the price hard. When money flows out, it drags the price down fast. Gold is different because it is a much larger market in dollar terms. It can take bigger flows and not move as violently. Silver cannot absorb the same kind of flow without big drama. So when a large trader moves in silver, the price can jump. And when a large trader leaves silver, the price can crash. The thinness turns normal decisions into violent candles. That is not a conspiracy. That is a small door with a big crowd. When everyone tries to squeeze through at once, someone gets crushed. Now add another problem. Silver supply does not respond smoothly when prices change. Even if silver gets expensive, miners cannot magically flood the market with new silver. That is because a big part of silver is mined as a byproduct. It comes out of mines that are mainly digging for other metals. So silver supply is tied to decisions made in other markets. That makes the supply stiff and slow. A higher price does not instantly create more supply. So when demand shifts, price must do more of the work. On the demand side, silver is heavily industrial. Many companies buy silver because they must use it. They buy it to build products, not because they love the price. So when price rises, demand does not always vanish. Instead, companies often hedge their costs, and that hedging can create short-term selling pressure during wild moments. So shocks do not get smoothed out. They often get amplified. The market feels like it is echoing because the structure makes the swings bigger. Here is where the moves can turn brutal fast. Silver's day-to-day price is set mainly in the futures market. Futures markets are full of leverage. Leverage means you control a lot with a little. It feels like a cheat code when the trade goes your way. But when the trade goes against you, it can blow up quickly. In a leveraged market, small drops can trigger a chain reaction. Stop-loss orders hit first, and more selling appears. Then margin calls arrive, and they force traders to sell. A margin call does not ask if you still believe in silver. It does not care about your long-term plan. It demands money now, and if you don't have it, you sell. That forced selling can feed more forced selling. The drop creates stress, and stress creates more selling. That is a feedback loop, and it can feel like a waterfall. And the same machine works in reverse. During rallies, shorts get squeezed, and forced buying can lift the price fast. That is why silver can explode upward and then crash downward. So when you see a sudden plunge, don't only think about villains. Think about leverage unwinding. Think about forced selling pushing the market beyond what feels normal. Gold is easier to move and store. It is dense, valuable, and simpler to transport in large value. That helps the market correct strange pricing faster. Silver is bulky and heavy for the same dollar value. Moving large amounts can be annoying and expensive. That makes quick fixes harder when prices get out of line. In markets, traders often try to arbitrage. That means they buy where something is cheap and sell where it is expensive. And with silver, that process can be slower, so distortions can last longer. So silver can stay weird for longer. It can stay choppy for longer. It can stay painful for longer. Silver is different because it lives in two worlds. Sometimes it trades like gold as a money metal. Other times, it trades like an industrial metal, tied to growth. When fear rises in the world, silver can catch a bid like gold. People run toward safety, and silver can rise with that wave. That feels exciting, and it can move fast. But when growth fears hit, silver can act like factory metal. Traders think about demand and the business cycle. That can pull silver down hard, even when gold looks steady. Switching between these roles creates instability. It's like silver is changing masks in the middle of a fight. That flip confuses traders and increases the swings. And silver attracts speculators who want big moves. They come for the speed and the drama. Their money brings emotion, and emotion brings bigger candles. So here is the simple truth. Silver is volatile because it is a thin, investable market. And in thin markets, big flows move price fast. Silver is also volatile because supply is stiff and demand is often industrial. Shocks do not get smoothed out quickly. They get amplified when the market is stressed. Silver is also volatile because futures and leverage dominate the short-term price. Margin calls can force selling, and forced selling can turn into a chain reaction. That is why the drops can look sudden and cruel. So what do you do with this? First, stop expecting silver to act calm. If you need calm, silver is not your tool. Second, stop calling every extreme move impossible. Silver has fat tails and storm mode is real. The more you respect that, the less you panic. Third, manage your risk like you respect reality. Silver can reward patience, but it can punish pride. And if you understand the structure, you can stop being shocked by days like this. This is educational content only. It is not financial advice, and it is not a promise of profits. Please do your own research and consider your own risk before making any investment decision. If you want more simple, no-hype breakdowns of markets and money, subscribe to the Bullion Ledger. If you've ever blamed manipulation after a big drop, tell me what you think now. And if you want to follow up, I can make a second episode on how to handle silver risk like a pro.